And welcome back to Kent's Corner. We've got a huge week in the market this week. We've got a lot of news. We have the Jackson Hole Economic Symposium going on this week. What is the symposium? This is an annual meeting put on by the US Federal Reserve, and it's hosting central banks from all over the world. And they're going to be talking about interest rates and really trying to determine on which direction are those interest rates going on globally. And this is a big deal. We had a report last week that there were the Fed meetings from July, but that really drove the market because the market was expecting interest rates to hold steady and then come back down. But then after listening to those Fed meetings, we're expecting interest rates higher for longer and even the potential of raising interest rates a couple more times. This is a big deal because are we going to push too far? Are we going to start breaking? Because some countries like China, they're hurting. Their economy has been tightened so much and it's so dependent on real estate, and those high interest rates are just crushing the real estate market that now they've had to drop interest rates twice just to try to keep that cash flowing in the economy. So they're in bad shape. We've been holding steady, holding tight, but it's one of those you've really got to see what's coming down the pipe. Now, I've been a whitewater rafting guide for almost 20 years now. And so when I'm trying to read the river, I can't make decisions on guiding through those rapids right now. I've got to see what's coming down 20, 30 feet downriver. And I've got to make moves now to be prepared for what's coming down the river. And that's what the Federal Reserve is trying to do right now. They're trying to make those moves to be prepared for those rapids in the future, but make those moves right now. And so if they can hold tighter for longer and slow down that cash flow, continue to bring down inflation without having that reanimation of inflation raising its super ugly head like that has happened in other countries, then we're going to be in good shape. But it's a delicate dance. So we're going to learn a lot this week. On Thursday, we've got a jobs report, the unemployment report coming out from the Department of Labor. And then Friday, Jerome Powell is going to be speaking at the symposium, and we are all going to be tuned in for that. So it's a big week this week. What happened last week? Well, the markets have been down. They've been down for 3 weeks straight, and that's after we had a 3-week rally before that. And the downturn started out when the Fitch downgraded the US government bonds. And so, you and I, consumers, we have our rating. So we have 3 major companies that put a rating on us. If we ever want to buy a car or buy a house, then they will give us a number saying what is our risk of taking out a loan that they're going to issue debt to us. And so if our debt to income ratio gets higher, then our number goes down. And it's the same thing with governments. You have these third-party organizations that rate these governments based on their debt to income ratio. And since the US, we raised our debt limit and our GDP, that's our income, has come down, then they downgraded our rating. Last time this happened, that was in 2011, and the Standard & Poor's downgraded us, and the market dropped a lot more than it has recently. So I would expect that volatility. We are going into September, where that is the worst performing month of the year. That's when mutual funds will rebalance. There's a lot of things going on, so expect more volatility. We're looking green today. We've had a little bit of a comeback today after last week's sell-off, but there's a lot going on. Bitcoin is down. Bitcoin was up over 31,000. It's dropped down below 26,000, come back up a little bit. Not too surprised there. There's a lot of correlation with the tech stocks, and not that Bitcoin itself is correlated with the tech stocks, but it's the investors. A lot of people that are investing in growth and in technology and AI are the same investors that are investing in cryptocurrencies and Bitcoin. So we're seeing that volatility go up and down that same road. And yields have spiked. We hit an all-time high since 2007, where the 10-year US Treasury Bond yield hit 4.35% last Thursday. It has dropped back down to around 4.25. That is a number that we're going to look at closely, because that yield, as bond values go down, yield goes up. And so that's something we look at for that inverted yield curve. That's something we look at as one of those leading indicators for a recession. I wouldn't be super nervous about that yet, but that's a pretty big deal when you have that 10-year yield hit a high since 2007. We'll be looking out this week. Thank you for coming in to Kent's Corner and listening to us. If you have any questions, please reach out to us. Please like this video and share it with people that you care about, that you think they would be interested in hearing these short snippets of what's going on. Thank you.